Hi, we're doing chapter 16 tonight. It's a smaller chapter, so it's definitely going to be less long than like previous weeks. And the types of problems are always the same for this chapter. So that's a plus for your midterm. So we're talking about complex financial instruments, so mainly derivatives and convertible bonds. So we're still talking about financial instruments. It's just that now we're really focusing on derivative instruments. And what are derivative instruments is that they get their values from an underlying financial instrument. So it's most likely a contract. And an example could be someone gets into a contract with a company to purchase their shares in 6 months for $5, and then in 6 months they're going to purchase their shares for $5 regardless of the market price. So you might have seen it come through. Call options are a type of derivative instruments. Put options, there's forward contracts, there's warrants. All of those are derivatives. And I think I went over this. Basically, the advantage of derivatives for the holder, so the person that is entitled to write in the future, is that it may cover some risk associated with the variation of the price of the underlying instrument. And the advantage for the company issuing the derivatives is that they're getting their money right now, because most likely they're paying a fee. The holder is paying a fee to enter into the derivative contract. So for derivatives, they have three characteristics. Is their value changes in response to the underlying instrument. So if the underlying instrument fair value changes, your derivative asset or liability is going to change in function of the fair value. They require little or no initial investment. So I said that they can pay a fee. The holder can pay a fee to enter into the agreement, but there's also sometimes where they don't have to pay a fee. And also they're settled at the future date. So some example options, forwards, futures. And the basic rules is that they are measured at fair value through net income. So any gains or losses in the variation of the fair value is put into the net income. Derivative can be included into a contract, like with convertible bonds, where a part of the contract is a non-derivative, like the bonds, and the other part of the contract are derivatives, like warrants. You're often going to see in the problems from past midterms that convertible bonds are often mixed with warrants. So that's the type of embedding into a contract that you're going to see. For options and warrants, how their value is that basically you're going to adjust your asset account if you're the holder for the fair value. So if your options at the date that you enter the contract, well, if you paid like $500 at the date to enter into the contract for your options, you're going to record an asset account of $500. And let's say at the end of the year, the fair value of that options is now $50,000. Then you're going to adjust by $49,500 your asset account to reflect the fair value of your option contract of $50,000. And the other leg of your journal entry is going to be a gain or loss depending on what happens with your market price versus the price that you have in the books. So basically, I think I explained a little bit what are options and warrants, but it gives the holder the contractual right to acquire or sell an underlying instrument at a specific price, which is going to be called a strike or exercise price, within a specific term, which is called an exercise period. And it allows the holder to protect themselves against declines in the market value of the underlying shares. And they also can contribute to the equity of the company without actually holding shares. Something to be careful for is that it's not because that there's a option contract that it means that there has been shares that have been issued in regards to that contract, either at the first date of the contract or at the end. So they have the option to exercise their right to buy the shares. Doesn't mean that they have to. That's the difference between options contracts and warrant contracts versus forward contract, where they have to buy the shares at a specific time. Here they have the choice. So I've put some call and put options are option contracts. You've seen them in COMP 308. I'm not going to go over that nightmare, but just so you know, that's what we're talking about when we're talking about options. And how we account for that. So at issuance, so the holder is going to record a financial asset, and they're going to credit the cash for the amount that they paid for an option to be written. So that means that they paid the writer, let's say $500 to get their options written. If it says that they didn't pay anything to get their options, then you don't have to put a journal entry. It's going to be specified in the problem. And for the writer, it's exactly same transaction but reverse. They're going to receive the cash from the holder, and they're going to create a liability derivative. When the fair value changes on the contract, the holder is going to book a gain or loss, and the gain or loss is going to depend on the book value that they have in their books, obviously, and the fair market value. So if their book value is greater than the market value, they're going to book a loss to decrease the value of their books to reflect the fair market value, and vice versa for if the market value is greater than their book value. Their transaction, they're going to either debit or credit their financial asset depending on what's happening. But in the case of a loss, they're going to record their loss, and they're going to decrease their financial asset to decrease their value in their books. For writer, it's the same transaction, same logic, but it's just that you have to look at it on the writer side instead of the holder side. So for them, they're recording a loss if the value, the fair value is greater than the amount in their books, because that means that they're going to have to pay more than if the market value was lower than their book value. So basically what's happening, the writer, they get into the contract with the holder. They say, okay, you can buy these shares in 6 months for this amount. And in 6 months, what happens is that they receive the amount from the holder, and they have to go buy it on the market, those shares for the market price. So for them, if their book value, if the fair value is greater than their book value, that means that they're paying more and then they're engaging into a loss. They prefer if the value of the option is lower than the market price, because they're going to have a gain. They're going to have a little bit of profit for the difference. I hope that was clear. And at exercise date, so when the holder decides, okay, I am actually gonna get the shares, they're gonna record an investment account for the number of shares on the option times the market price. So that's the only time you're using the market price for the holder. Then you're gonna either plug a loss or a gain. They're gonna credit their financial asset book value, and they're gonna pay cash to the writer the amount of number of shares on options times the strike price. For the writer, what's happening here, they're receiving the money from the holder. So they're going to debit cash for the number of shares on the option times the strike price, and they're going to increase their liability for the same amount. Then they go on the market and they buy the shares. So they're going to credit their liability derivative for the amount in the book. So the amount in the book is any adjustment for the fair value plus the amount that they receive from the holder. They're going to have a gain or loss, and they're going to pay cash the market value of those shares. So number of shares on the option times the market price. If the holder decides to cash their option instead of getting the shares, they're going to receive cash, the number of shares, times the difference between the market price and the strike price. And they're going to credit their financial asset for their book value and book a gain or loss. And for the writer, they're going to debit their liability, cash in whatever the holder is paying them. Pay to the holder the amount that the holder is receiving, and then book a gain or loss. So that's pretty much it for options and warrants. Forward contracts are accounted for the same way as what we just saw. It's just that instead of having a choice at the end of the contract to either buy the common shares for the strike price, they have no choice but to buy the shares of the strike price. An example that was used by the teacher when I took the class was that two companies entered into a contract where one purchased the US dollars for a fixed in the future for a fixed Canadian rate. So I buy you 500 US dollars for $1.1 in 6 months, regardless of what is the market rate. And for forward contracts, at the issuance date, it's rare that you're going to have a journal entry. Normally, it's going to be 0 because they think the way that they account for it is that the present value of the future amount that they're going to pay at let's say $1.1 in Canadian is 0. So that's how they see it. So you're going to account for any changes in fair value based on what they give you in the problems, but your first transaction is going to be 0, so no entry. For convertible bonds, that happens when, let's say, the company issues bonds and they say you can convert your bonds into 3 common shares or 3 preferred shares, stuff like that. IFRS and ASPE use the book value method, and that's what I'm going to show you. And you're going to issue, when you're having convertible bonds, you're going to have the debt portion, which is bonds payable, which is what we've seen before. And you're also going to have an equity portion, which is going to be a contributed surplus conversion rights. So you're going to account for the fact that the bondholders probably paid a premium on issuance of the bonds to be able to convert their shares at a later date. So you want to account for it. Also, commonly, in your problems, you're going to see warrants linked with convertible bonds, and the warrants are going to be valued separately, and they're going to be considered equity. So you're going to have a contributed surplus conversion rights for your convertible bonds, and you're also going to have a contributed surplus warrants to account for the warrants. But be careful, because you're going to account for your warrants, but they're not going to come and affect your convertible bonds entry. And the problems for tonight, I put 2 problems. One is only convertible bonds, and one is bonds with warrants. And for the midterm review, I'm going to do one where there's convertible bonds with warrants. So you see like all the options regarding the accounting for them. So when the bonds are issued, like I said, you're going to account for the debt portion and the equity portion. The cash portion is going to be the amount that the bondholders paid. Most likely it's going to be at a premium. So you're going to see like we paid 105 to get these bonds. Your bonds payable is going to be the present value of your debt, like we saw last week. And your contributed surplus is going to be a plug. So it's going to be the difference between your cash and your bonds payable. When the bonds are converted into common shares, could be common shares, could be preferred shares, you're gonna basically reverse your contributed surplus amount that you recorded at issuance. Your bonds payable amount is going to be your book value, and hopefully it's your maturity value. And you're going to issue the common shares for the plug amount. If they say that only 1% of bondholders converted their bonds into common shares, then you're going to apply that percentage to your amounts of bonds payable and contributed surplus. So let's say 70% of the bondholders converted, then you're going to do 70% of your book value and 70% of your amount at issuance for the contributed surplus. If there's no conversion at the end of the contract, you're going to remove from your books the bonds payable amount, which hopefully is the maturity value. You're going to remove from your books the conversion rights, so whatever amount was at issuance, and you're going to credit your cash for the plug because you're paying the bondholders back their premium that they paid for the convertible bonds. If there is an early conversion of bonds, the accounting treatment for ASPE and IFRS is different. So that means that instead of converting them on like June 30th, they decide to do it on March 1st. Then they're gonna have to pay extra money to convert their bonds early. And how that extra money is assigned is that first you're gonna calculate a debt retirement cost. And this is the difference between the market value and the book value of your bonds. And if this doesn't cover the total amount of your cash payment, you're gonna put any excess to your return earnings by diminishing them. So you're gonna debit return earnings. Transaction is gonna look something like that, like this. You're gonna credit your bonds payable for the book value. You're gonna debit your contributed surplus conversion rights for the amount at issuance. You're going to have your debt retirement cost for the difference between the market value and the book value of your bond. Your return earnings is going to be the cash that they have paid minus your debt retirement costs. Cash is given, and your common share amount is going to be your bonds payable and your conversion rights. So the first two is equal to common shares. The last two is equal to your cash. And under IFRS, the entire payment is considered a loss. So you're going to have, again, bonds payable, contributed surplus, same amount. And your loss on retirement and cash is equal for the amount that they say in the problem. And that's pretty much it for the theory. Any questions? Oh, I don't have an Excel sheet. Take that as no. All right. So further problems. The first one I think is bonds with warrants. So the reason why this is also on your midterm is because there's a lot of notions from chapter 14 that is applied to chapter 16 in regards to the convertible bonds. So don't a lot of the times the questions are mixed together for chapter 14 and chapter 16. So be used to doing those two together. So for question 1, Tweaker Inc. is a social media corporation and has opted to follow IFRS. It issued 25-year 8% bonds with a maturity value of $300,000 on January 1st, 2010. 3 warrants were attached to each $1,000 bonds. Each warrant entitled its holder to purchase 1 common share in Tweaker at $130 each. Based on a market-based expected yield of 10%, the company priced the bonds only at $253,000 The market value of the warrants on the date of the issue was $27 each. On March 31st, 2015, when the market price of 3Q's shares reached $180, 70% of the warrant holders exercised their options to purchase shares in the company. Thereafter, on December 31st, 2018, when the market conditions seemed favorable, the company called in 30% of the outstanding bonds at 105 and canceled them. The recorded balance of the bond discount on June 30th, 2018 was $28,000. Similarly, on December 31st, 2018, the balance was $26,000 and $24,000 on June 30th, 2019. So first, they asked us to prepare the journal entry for the issuance of the bonds on January 1st, 2010. That's what we're going to do. So how did we issue bonds last week? We had a cash amount that we received. We had a bonds payable amount for the present value of the bonds. And now what we're going to add to it is our warrants portion. So they issued the bonds with warrants that were attached to it. So the warrants are going to be in our contributed surplus warrants. Your cash amount is going to be applied after I found the bonds payable and contributed surplus warrants because they don't give it to us. If they had given us the amount that they paid, then we could put it there. The bonds payable is your present value of your maturity value, but here they said that the company priced the bonds only at $253,000. So that's going to be my present value. And for the contributed surplus warrants, how it is calculated, it's the number of bonds times the number of warrants per bonds times the strike price. No, sorry, not strike price, market price. At the issuance date. So here, if we look, we know that our maturity value, to find the number of bonds, we know that our maturity value is $300,000, and we know that they're $1,000 bonds. So I'm going to do 300,000 divided by $1,000 to find the number of bonds that they issued. Then I'm going to do times the number of warrants per bonds, which is 3 warrants per bonds, times the market value of the warrants on the date, which is $27. And then my cash amount is going to be the sum of the 2 credits. Any questions? No? Okay. So then we are going to do the journal entry on June 30th, 2010. So June 30th, 2010 is the first payment date for interest, right? Yeah, so they pay interest, well, they pay coupon, whatever, on June 30th and December 31st. So the first, how we account for it, we record our interest expense. We're going to have our cash, and it's going to be an increase in bonds payable because it was issued at a discount because the value here is lower than our maturity value. So to find my interest expense, if we remember from last week, how we find it is we use our book value from the previous period times the market rate divided by the number of payments per year. So here, my previous book value was the book value from January 1st, 2010. So the 253,000. My market rate is 10% based on the market base expected yield of 10%. And there's 2 payments per year. Cash amount, if we remember from last week, is the maturity value times the coupon rate divided by the number of payment per year. So here is 300,000 times a market rate of 8% divided by 2 payments, 2 periods. And the difference is gonna be $694. So here we did 253,884 times 10% divided by 2. And here we did 300,000 times 8% divided by 2. So that's all you have to do for June 30th. Then they ask us for the interest expense recorded for the year 2010. We already have the first amount for June 30th, 2010, which is this amount here, the $12,694. And then we're also going to have the amount on December 31st, 2010, which is basically the book value on June 30th times 10% divided by 2. So to find the book value on June 30th, we're going to do our book value on January 1st plus the increase in book value from June 30th, which is 694 times 10% divided by 2. So our interest expense is $25,423. This is not really chapter 16, this is chapter 14, but hard to find a problem that's only chapter 16. All right, then for 4, they ask us to record to the journal entry to record the exercising of the warrants on March 31st, 2015. So I'll go look here what they said. Say that when the market price of Tweaker shares reach $180, 70% of the warrant holders exercise their options to purchase shares in the company. All right, so what is happening here? The company is going to receive some cash from the warrant holders. The cash amount here, I'll put it here. I did the 253,884 plus 694 times 10% divided by 2. So my book value, my increases in bonds payable for the year. So for the cash amount, how you're going to calculate it? You're going to find the number of warrants. The number of bonds times the number of warrants per bonds times 70%, because only 70% of the warrants were exercised, and times the strike price. So I'll put it here, number of bonds times number of warrants per bonds times percentage of exercise times the strike price. For this problem, the number of bonds is again 300,000 divided by $1,000. The number of warrants per bond is 3. Percentage is 70%, and the strike price is $130. I'm going to come and debit some of the contributed surplus. And since it's only 70% that were exercised, I'm only going to debit 70% of what we recorded at issuance. So it's going to be 70% of the 24,300.
Sorry, Floss. It's just my question is, when would you use the because there's $130 and there's also $180, so you would always use the one from Tweaker in their books, right?
Yeah,
Is that it?
you always use a strike price. They put the market price here to kind of trick you, so you take the market price on the date. But another question that comes with it is, why did they did they exercise their rights on March 31st, 2015? Well, it's because now, instead of buying the shares on the market for $180, they can buy them for $130. So it's cheaper for them to exercise their rights on March 31st instead of, instead of buying them on the market. So they're putting it there to trick you, but also there's the logic of the market price is higher than your strike price.
Okay, so if the question was like, what would the investor have in their books, it would be the 180, right? Instead of the 130.
Yeah, so the
Okay.
investors, they would have an investment at 180, credits their cash for 130, and a gain for $50 times the number of shares.
Perfect, thank you.
No problem. All right. For this transaction, all we're left with is the common shares. And it's basically the sum of these two. All right. And then they're asking us to do the journal entry for the retirement of the bonds on December 31st, 2018. So it's talked about here. And we're also going to need some of the information that's in the last sentence. So on December 31st, 2018, they retired 30% of the outstanding bonds at 105. So how you account for it, you're going to remove, well, 30% of the book's value of your bonds payable. So to find your book value, here, how they accounted for it is instead of doing like, like what I did here, basically they have like another portion to their, and it's the discount. Yeah, they have the discount here. And their bonds payable is 300,000. And then their discount was whatever the difference between the three is. My journal entry is not wrong. It's just I don't like to do it that way. Don't know why, just a preference. But what they're saying here is that the balance of that discount amount in their books on June 30th was 28,182. On December 31st, 2018, it was 26,589. And on June 30th, 2019, it was 24,000. So here, the amounts here is the unamortized discount on their bonds. So to find the book value net of the bonds payable, you do maturity value of 300,000 minus $24,918 to find the book value on June 30th, 2019. So here to find the book value on December 31st, 2018, what I want to do my maturity value of 300,000 minus the discount for December 31st, 2018, which is the 26,589. So 300,000. And this gives me the book value for 100% of the shares, but they only, sorry, not shares. I get all my words mixed up. 100% of the book value of the bonds payable, but you're only removing from your books 30%. So I'm going to do my book value times 30%. Then what's going on, you're going to have a gain or loss. So I'm going to leave that to the end, and you're going to have the cash amount. So the 105 that they paid to cancel their bonds. So it's going to be 105 times your maturity value of 300,000 times 30%. And then you're going to have a loss on retirement bonds. This is basically the transaction that we saw last week. Just a little refresher. All right, so that's it for warrants. So as you saw, like the accounting for warrants is pretty much separate from the accounting for bonds, except at issuance, you're gonna put them in the transaction. Same logic when you're gonna have convertible bonds issued with warrants. You're gonna account at issuance for both. And then after you have separately, you're accounting for the warrants, and then separately, you're accounting for the convertible bonds. For question 2, speaking of convertible bonds, Dieter Limited issued 10-year 6% bonds on January 1st, 2009 at 104. The bonds had a face value of $500,000 and interest was paid twice a year on July 1st and January 1st. After 1 year, each $1,000 bonds could be converted into 50 common shares. The bonds would have been sold for $375,000 without the conversion feature to yield a 10% return. The company records both the debt and equity components of the transaction as per ASCO. On July 2nd, 2010, after the payment of the interest on July 1st, the 3/5 of the bonds were converted into shares. Dieter uses the effective interest method for recording bond interest and uses the book value method to record the security conversions. So we're gonna record the issuance, the interest that was paid on July 1st, 2010, and then the bond conversion on July 2nd, 2010. So first, my issuance. As always, you're gonna have a debit to your cash account for the amount that was received. And in this case, you say that they issued it at 104. So the amount is 1.004 times the maturity value of 500,000. So here, bond holders pay the premium, most likely pay the premium because they can convert their bonds into common shares at a later date. You're gonna have your contributed surplus, conversion rights, and you're gonna plug it once we get our bonds payable amount, which is the amount that it would have been sold without the conversion feature. So it's the 375,000. And so my contributed surplus is the difference between the two. So it's 144,622. For the entry on July 1st, 2010, you're going to want to record your interest expense, your increase or decrease in bonds payable, and your cash payment. So I'm going to do a little amortization schedule because there's like a year that passed, I think. January, no, 4 payments that passed since. Yeah. So I'm going to have my cash, my interest expense, my premium, no discount, and then my book value. So on January 1st, 2009, we had a book value of 375,000. On July 1st, 2009, your cash amount is your coupon rate of 6%, divided by 2 payment period, times your maturity value of 500,000. Your interest expense is the 10%, I think. Yeah, 10%, the market rate, divided by 2 again, times your book value of 375. Discount is the difference between the two. And you add it to your book value to increase it. So I'm going to do the same for January 1st, 2010, and then July 1st, 2010. So my entry would be interest expense for the amount here of 19,155. My bonds payable would be increased by 4,155, and my cash amount is the 15,000. So that's your entry. And then on July 2nd, for the conversion of the bonds, you're going to remove 3/5 of the book value of the bonds payable. So 3 divided by 5 times the book value that we found here, so the 387,000. You're gonna remove 3/5 of your contributed surplus at issuance. And the common shares that were issued, the value is the same as your debits. And that's it for the conversion of bonds. And lastly, it's about call options. So where we record the changes in the fair value over a time period. So on June 1st, 2018, DCI purchased a call option for $450, which gave it the right to buy 10,000 shares of iLines Inc. for $54 each until December 1st, 2018. On that date, iLines shares were being traded for $52. On June 30th, 2018, the option contract could be traded in the market at $96,000. On December 1st, 2018, with the shares being traded at $70 each, DCI exercised the option and took delivery of the shares of iLines. We're going to do the journal entries on June 1st, 2018, when they acquired the call options. On June 30th, 2018, when they closed their books of accounts, so I'm guessing their year end is on June 30th. On December 1st, 2018, if they exercise the call options and they take delivery of the shares. And on December 1st, 2018, if they settle the call options for cash without getting any shares. So first on June 1st, 2018, when they acquired the call option, they say that they purchased a call option for $450. So that's what we're going to record in the books for DCI. So they're going to have a derivative financial asset for $450, and you're going to credit your cash amount for $450. If they said that they entered into a option contract without paying any costs, so zero, you don't have this entry. And on June 30th, 2018, they say that the fair value of the option contract in the market was $96,000. So in your book right now, your option contract is worth $450, but you want it to be $96,000. So you're going to record a gain for the difference between the two to bring your book value to $96,000. I'm going to increase my financial asset by $96,000 minus the $450 that we booked earlier. And this is going to be a gain on derivative. And it's going to be in your net income for the year. On December 1st, 2018, they take delivery of shares. Now what they're going to have to record an investment for the iLine shares. So the investment amount, iLines, is going to be the number of shares times the market price. So they can buy 10,000 shares. So the number of shares is 10,000. And the market price is $70 on December 1st, 2018. So it's going to be 10,000 times $70. They're going to come and reduce their derivative financial asset by the amount that they have in the books, which is 96,000. But if you want to see here, it's the increase on June 1st and the increase on June 30th. They're gonna pay 10,000 shares times the strike price of $54. So that's what I'm gonna put it here. So this is 10,000 shares times $70. So the market price. And here is 10,000 shares times $54, the strike price. And the difference between the two, why do I have like, yeah, okay, hold on. Difference between the two is going to be a gain of 64,000, I think. So the difference between your debit and your credit, I think it's gain on derivative. It doesn't really matter at this point. So 700,000 minus your credits, so 64,000. Now on December 1st, if they didn't take delivery of the shares and they just cashed it out, they're going to receive cash for the number of shares times the difference between the market price of $70 minus the strike price of $54. They're going to have a gain or loss. And they're going to come and credit their derivative financial asset account for 96,000, and they have a gain of 64,000 again. Yeah, and they have a gain of 64,000. So here I did 10,000 shares times $70 minus $54. Here's the book value, and here it's the flood. And that's it. That's it for tonight. Any questions on any of the questions that we covered? Stop.
Yeah, maybe I have a question for you on for the first one.
Yeah.
Let me just go through. Okay, so yeah, I kind of got confused on the recorded balance of the bond discount on June 30th, and then it says it's 20,182. Because normally when you have the amortization table, you have when it's discounted, you would add up the amortization, but in this case, you would remove it, right? From the fair value.
Hold on, I'm gonna just correct my transaction. Maybe it's gonna be.
Yeah.
Here it's. What did I do here? It's the 253,884. So you add it because it's been issued at a discount. So your bonds payable book value is lower than your maturity value. So at each payment period, you want to increase your book value to get to your maturity value of 300,000. So on June 30th, you increased your book value by $694. So your book value now on June 30th is your value on January 1st plus the increase on June 30th. So it's now 254,578. Did that answer?
I think well, my question was on the last one. So on
here
on five, yeah. So
okay.
Is that what you're answering? I'm not too sure. So just on the last statement, it says the recorded balance of the bond discount on June 30th is for 20x8 was 20 8,000. So we removed, no, sorry, we took the 26,589. So we removed that amount from the fair value, right? Because it's bond discount.
Yeah, we remove it from the maturity value. So this is basically what has not been amortized yet in your schedule.
Okay, so it's
Okay.
always a, so they might ask you, they might give you that it's a bond premium. If it's the bond premium, you would do fair value plus the amount of bond premium, right?
Yeah.
Okay.
Exactly.
Okay, perfect. Thank you. That's it.
Okay, no problem. And then for this question on March 31st, I think here, how did I get the 81,900? I did the number of bonds. Oh, I didn't put it in writing. So I did 300,000. So this is your maturity value of the bonds divided by $1,000 because they're worth $1,000. So you get your number of bonds times the number of warrants, which were 3 per bonds, times 70%, because only 70% of the warrants holders exercise their options, times the strike price of $130. So that's how I got to the 81,900. No problem.